Good morning, and thank you all for joining us. As a reminder, this conference call and the related presentation may include forward-looking statements, which reflect management's expectation about future events and overall operating plans and performance. These forward-looking statements are made as of today and are not guarantees. They involve risks, uncertainties, and assumptions, and there can be no assurance that actual results will not differ materially from our expectations. For a discussion of these risks and uncertainties, please see the risks described in our most recent Form 10-K and subsequent filings with the SEC. Invesco makes no obligation to update any forward-looking statement. We may also discuss non-GAAP financial measures during today's call. Reconciliations of these non-GAAP financial measures may be found at the end of our earnings presentation.
Welcome to Invesco's third quarter results conference call. All participants will be in a listen-only mode until the question and answer session. At that time, to ask a question, please press star 1. This call will last 1 hour. To allow more participants to ask questions, only one question and a follow-up can be submitted per participant. Today's conference is being recorded. If you have any objections, you may disconnect at this time. Now, I would like to turn the call over to your speakers for today, Marty Flanagan, President and CEO of Invesco, and Allison Dukes, Chief Financial Officer. Mr. Flanagan, you may begin.
Thank you, operator. I appreciate it very much, and thanks everybody for joining us. And I'll make a few comments and turn it over to Allison, so she can review the quarter in more depth, and then we'll open up the Q&A as we always do. And hoping everybody's staying safe and healthy as we continue to return to normalcy, and I know we're all looking for that pace to continue in the months ahead. Continue to have a high level of engagement with our clients, which is even more important as we navigate the market uncertainty brought about by the end of economic and market upside surprises we experienced from the depths of COVID. Helping our clients by providing insights and solutions utilizing our broad range of capabilities. This approach has helped us deliver strong, consistent growth over the past 5 quarters. And as you can see on slide 3, if you're following along on the deck, net long-term flows were $13.3 billion during the quarter. This represents over 4% annualized long-term organic growth for the quarter. Growth was driven by continued strength in a number of our key capabilities, including ETFs, fixed income, China solutions, alternative, and global equities. Strategically, we continue to invest in areas where we see client demand and where we have competitive strength. And since the third quarter of last year, we've generated $86 billion of long-term inflows, an average quarterly organic growth rate of 6%. 5 consecutive quarters of strong growth of the direct result of the investments we've made over time to enhance and evolve our business to meet client needs. ETFs, excluding the Qs, generated long-term inflows of $3.7 billion in the quarter, with strong market share gains in our EMEA ETF range. In private markets, we generated net long-term inflows in our direct real estate business of $1.2 billion, and robust bank loan product demand resulted in net long-term inflows of $2 billion during the quarter. This included a launch of a new CLO. We generated net long-term inflows of $11 billion within active fixed income across the platform. And within active global equities, the Developing Markets Fund, a key capability that came over when we combined with Oppenheimer, continue to see net long-term inflows of $700 million during the quarter. That said, we remain focused and continue to work on areas where there's opportunity for improvement. In addition, our solutions-enabled institutional pipeline accounts for 38% of the pipeline at quarter end. Third quarter flows included net long-term inflows of $6.8 billion from Greater China. Our China business continues to be a source of strength and differentiation for Invesco. We continue to expect the Chinese investment management industry to be the fastest growing market in the world for the foreseeable future. We are an early entrant 20 years ago, and we are benefiting from that commitment and investment, and we expect to see continued growth in the years ahead. Before I turn the call over to Allison, who will provide more information on the China business and the results, I'd like to note that the growth we are experiencing is driving positive operating leverage, producing adjusted operating margin of 42% for the quarter. The strong cash flow being generated from our business improved our cash position and helping build a stronger balance sheet and improving our financial flexibility for the future. Invesco's depth and breadth of capabilities and competitive strengths position us well as we look forward. We continue to focus our efforts on delivering positive outcomes for our clients while driving future growth. And with that, let me turn it over to Allison.
Thank you, Marty. Good morning, everyone. Moving to slide 4, our investment performance was strong in the third quarter, with 72 and 74% of actively managed funds in the top half of peers were beating benchmark on a 5-year and a 10-year basis. This reflected continued strength in fixed income, global equities, including emerging market equities and Asian equities, all areas where we continue to see demand from clients globally. Moving to slide 5, we ended the quarter with $1.529 trillion in AUM, a net increase of $3.6 billion. As Marty noted earlier, our diversified platform generated net long-term inflows in the third quarter of $13.3 billion, representing a 4.4% annualized organic growth rate. Active AUM net long-term inflows were $6.8 billion, and passive AUM net long-term flows were $6.5 billion. Market declines and FX rate changes led to a decrease in AUM of $18.6 billion in the quarter. The retail channel generated net long-term inflows of $1.8 billion, driven by positive ETF flows and inflows in Greater China. The institutional channel demonstrated the breadth of our platform and generated net long-term inflows of $11.5 billion in the quarter, with diverse mandates both regionally and by capability funding in the period. Regarding retail net inflows, our ETF, excluding the QQQ, generated net long-term inflows of $3.7 billion. Year to date, we have captured global ETF market share. Our global ETF platform, again excluding the QQQ, captured a 3.8% market share of flows, which exceeded our 2.7% market share of AUM. We have also captured a higher share of the global ETF revenue pool over this period. Our market share of the revenue pool was 5.6%. Net ETF inflows in the United States does include net long-term inflows of $900 million into our QQQ Innovation Suite, which crossed $3 billion in AUM 1 year after its launch. Our EMEA-based ETF range generated $2.5 billion of net long-term inflows in the quarter, with particular strength from the IVZ S&P 500 UCITS ETF and the Gold Exchange-Traded Commodity Fund. Looking at flows by geography on slide 6, you'll note that the Americas had net long-term inflows of $4.8 billion in the quarter, driven by net inflows into ETFs as mentioned, as well as our institutional flows. Asia Pacific again delivered another strong quarter with net long-term inflows of $9.3 billion. Net inflows were diversified across the region, reflecting $6.8 billion of net long-term inflows from Greater China, most of which arose in our JV, and $3.1 billion from Japan. Turning to flows across asset classes, we continue to see broad strength in fixed income in the third quarter, with net long-term flows of $11 billion. Drivers of fixed income flows include institutional net flows into various fixed income strategies through our China JV, global investment grade, stable value, and municipal strategies. Our alternatives asset class holds many different capabilities, and this is reflected in the flows that we saw in the third quarter. Net long-term flows in alternatives were $2.3 billion, driven primarily by our private markets business, through a combination of inflows from direct real estate, the newly launched CLO that Marty mentioned, and senior loan capabilities. When excluding global GTR net outflows of $1.7 billion, alternatives net long-term inflows were $4 billion. The strength of our alternatives platform can be seen through the flows it has generated over the past 5 quarters, with net long-term flows totaling $12 billion, an organic growth rate that's averaging nearly 6% per quarter over this time when excluding the impact of the GTR net outflows over this period. Turning to slide 7, I wanted to spend a few minutes on our business in China, particularly given the level of flows we have seen from the region over the last several quarters and the high level of interest in our business there. Invesco launched the first Sino-US JV in China in 2003 as Invesco Great Wall. We've been in the market for almost 2 decades with a unique JV structure and relationship with our partner. How we operate in China is differentiated from others that have joint ventures. While we have 49% ownership of the JV, our partner is a Chinese government-backed power company and has been a good partner. We've been leading the management of the JV, leveraging our global asset management expertise since the inception of this partnership. We run the business in China with Chinese management, and our clients are Chinese investors. China's fund management industry is a very significant opportunity. In 20 years, it has grown from almost nothing to around $3.5 trillion. It's expected to become the second largest fund management market in the world by 2025, with assets of over $6 trillion. Also, China is estimated to account for over 40% of global net flows through 2024. Invesco, as an early entrant in China, has developed a strong and comprehensive platform covering all business activities, including robust domestic investment capabilities with good long-term performance track records. We have very strong relationships with banks and insurance companies, and digital distribution has been a major contributor in recent years in terms of bringing in new onshore business. Key opportunities for Invesco in China include mutual funds, institutional clients, and sovereign wealth funds. As China continues to open up and improve its capital markets, we also expect opportunities in pension reform, global investors increasing interest in investing in Chinese investments, and cross-border investment opportunities. The relationships, the unique business model we established with our JV partner, and the amount of AUM we have sourced from Chinese onshore investors really sets us apart from other global asset managers who are newer entrants in the Chinese market. Moving to slide 8, we have built a diversified business in China with over $99 billion in AUM at the end of September. 60% of the AUM is from retail clients and 40% is institutional. We manage AUM in all asset classes, and distribution is unique. Digital distribution to retail investors has become a mainstream channel, along with the traditional bank distribution channels, and this is not just for money market funds. With our market position and tenure in China, we are beneficiaries of this trend. Our long-term commitment and strong track record have put Invesco in an advantageous position, and our strategic position and continued investment in China has resulted in a 42% annual growth rate over the last 3 years to date. In recognition of the strength of the business, Invesco was ranked the #1 China onshore business and the #3 foreign asset management firm in overall China in 2020. Before we wrap up this discussion on China, in light of the recent developments around Evergrande, I want to note that our overall exposure as a direct equity or fixed income holding across the complex, including within our JV, is de minimis. Market volatility and offshore markets, of course, does impact AUM levels, and the market has been and could be volatile for future real estate developments. We remain positive towards the fundamentals of China's economy, and most of the flows in our China business come from domestic onshore clients. So if anything, we've seen a flight to quality as investors look to NAV-based products like the ones IGW offers. Now moving to slide 9 to look at the institutional pipeline, which was $32 billion at the end of September. The pipeline remains relatively consistent to prior quarter levels in terms of both asset and fee composition. Overall, the pipeline is well diversified across asset classes and geographies. Our solutions capability enabled 38% of the global institutional pipeline and created wins and customized mandates. This has contributed to meaningful growth across our institutional network. Turning to slide 10, you'll note that net revenues increased $31 million, or 34.4 basis points, a decrease of 0.4 of a basis point from the second quarter yield level. The decrease was mainly driven by asset mix shift, including higher QQQ and money market and the full impact on the net revenue yield for the third quarter was 0.6 of a basis point. Looking forward, we expect will continue, the degree of which will be influenced by market direction, especially if we see a divergence in performance in areas such as developing or emerging markets where fees tend to be higher than our firm average. We do expect the discretionary money market fee wage in the foreseeable future until rates begin. One other area I want to note before moving to expenses, we have realized meaningfully higher performance than driven typically by a few funds each year generate performance fees, usually in the fourth quarter. This year we do not increase in the fourth quarter. We expect performance fees in the quarter will be more in line with the quarters of the year. This is due to vintages in our portfolio not being at the life cycle stage of recognizing performance fees, which is typically near the end of the life of the fund and is in no way related to the performance of the fund. Total adjusted operating expenses increased 1.2% in the third quarter. The $10 million increase in operating expenses was mainly driven by variable compensation and property, office, and technology expense. Higher variable compensation was driven by the revenue increase in the quarter, partially offset by savings resulting from our strategic evaluation. The increase in property, office, and technology expenses was largely driven by changes to the pricing of transfer agency services that we provide to our funds, as we noted last quarter. This change went into effect in the third quarter and resulted in a $6 million expense increase, which was offset by a corresponding increase in service and distribution revenues. As a reminder, we anticipate that our outsourced administration costs, which we reflect in property, office, and technology expense, will increase by approximately $25 million on an annual basis, or approximately $6 million per quarter. And offsetting this will be a corresponding increase in service and distribution revenues, resulting in a minimal impact to operating income. Operating expenses remained at lower than historic activity levels due to pandemic-driven impacts to discretionary spending, travel, and other business operations. However, we did see a modest increase in client activity and business travel in the third quarter. As we look ahead to the fourth quarter, our expectations are for fourth quarter operating expenses to be relatively flat compared to the third quarter, assuming no change in markets and FX levels from September 30th. Consistent with prior years, we expect a modest seasonal increase in marketing-related expenses in the fourth quarter. And one area that's still more difficult to forecast at this point is when COVID-impacted travel and entertainment expense levels will begin to normalize. We are engaging in more domestic travel and in-person client activities, and we do expect to see continued modest resumption of these activities in the fourth quarter. Moving to slide 11, we update you on the progress we have made with our strategic evaluation. In the third quarter, we realized $5.8 million in cost savings. $4 million of these savings was related to compensation expense associated with reorganization, and $2 million was related to property expense. The $5.8 million in cost savings, or $23 million annualized, combined with the $125 million in annualized savings realized through the second quarter in 2021, brings us to $148 million in total, or 74% of our $200 million net savings expectation. We expect the total program savings of $200 million through 2022 would be roughly 65% from compensation and 35% spread across the other categories. In the third quarter, we incurred $18 million of restructuring costs. In total, we've recognized nearly $190 million of our estimated $250 to $275 million in restructuring costs that were associated with the program. We expect the remaining restructuring costs for the realization of this program to be in a range of $60 to $85 million through the end of next year. As a reminder, the costs associated with the strategic evaluation are not reflected in our non-GAAP results. Now going to slide 12. Adjusted operating income improved $21 million to $562 million for the quarter, driven by the factors we just reviewed. Adjusted operating margin improved 60 basis points to 42.1% as compared to the second quarter. Most importantly, our degree of positive operating leverage reflected in our non-GAAP results was 1.7 times $1 million, driven primarily by unrealized gains in our co-investment portfolios. The effective tax rate for the third quarter was 24.4% compared to 22.8% in the second quarter. The rate increase is primarily due to an increase in the reserve for uncertain tax positions. We estimate our non-GAAP effective tax rate to be between 23 and 24% for the fourth quarter. The actual effective tax rate may vary from this estimate due to the impact of non-recurring items on pre-tax income and discrete tax items. Looking at slide 13, we illustrate our ability to drive adjusted operating margin performance against the backdrop of the client demand-driven change in our AUM mix and the resulting impact on our net revenue yield excluding performance fees. Our operating margin in the third quarter of 2019, which was the first full quarter following the acquisition of Oppenheimer, was 40.9%. At that time, we reported a net revenue yield of 40.7 basis points. In the third quarter of 2021, our net revenue yield had declined over 6 basis points to 34.4 basis points. Yet our operating margin has improved to 42.1%. This chart starts at the third quarter of 2019, but in fact, our third quarter 2021 operating margin is the highest since Invesco became a U.S.-listed company in 2007. This is against a backdrop of a mix-driven decline in net revenue yield. We've been building out our product suite to meet client demand, and client demand has been tilted towards lower fee products. In fact, the growth of the QQQ over this period is remarkable, almost tripling in size and going from 6% of our AUM mix in the third quarter of 2019 to 12% at the end of this quarter. Even though we do not earn a management fee as sponsor of the QQQ, we manage the over $100 million annual marketing budget generated by the product. The marketing budget has allowed Invesco to further raise awareness about the QQQ. That increased awareness has resulted in its ability to significantly increase our market share in the ETF space. Invesco is today the fourth largest ETF provider in the world. Growth in the QQQ accounts for 2 basis points of the net revenue yield decline over the period shown on this chart. And as I noted earlier, discretionary money market fee waivers account for a 6 basis point decline in the net revenue yield. These two factors alone account for over 40% of the decline in the net revenue yield over this period. Realizing our business mix is shifting, we continue to be focused on aligning our expense base with the changes in our business mix, which has enabled the firm to generate positive operating leverage and operating margin improvement. Now, a few comments on slide 14. Our balance sheet cash position was $1.8 billion on September regulatory requirements. The cash position has improved meaningfully over the past year, increasing by nearly $700 million, largely driven by the improvement in our operating income. Our debt profile has improved considerably as well, with no draws on our revolver at quarter end. As a result, we have substantially improved our net leverage position, as shown in the top right chart on this slide. Our leverage ratio, as defined under our credit facility agreement, declined from 1.43 times a year ago to under 1 times at 0.86 turns at the end of this third quarter. If you choose to include the preferred stock, the leverage ratio has declined from just over 4 times to 2.67 times at the end of the third quarter. LP liability in the third quarter, reducing the liability from our previous estimate of nearly $300 million down to $254 million. We anticipate funding the liability this quarter, and we have ample cash resources to do so. While we anticipate a degree of insurance recovery related to this, the insurance claims process is inherently complex, and we do not have an update at this stage as to the exact timing or size of the recovery. Regarding our capital strategy, we are committed to a sustainable dividend and to returning capital to shareholders through a combination of modestly increasing dividends and share repurchases. As we look towards 2022 and beyond, we will be building towards a 30 to 50% total payout ratio over the next several years as we continue to modestly increase dividends and reinstate a share buyback program in the future. Overall, we believe we're making solid progress in our efforts to improve liquidity and build financial flexibility. In summary, we continue to see growth in our key capabilities. We remain focused on executing the strategy that aligns with these areas while completing our strategic evaluation and reallocating our resources to position us for growth. And finally, we remain prudent in our approach to capital management. We're in a very strong position to meet client needs and run a disciplined business and to continue to invest in and grow our franchise over the long term. And with that, I'll ask the operator to open up the line for Q&A.
Thank you. At this time, if you would like to ask an audio question, please press star 1. You will be announced prior to asking your question. Please pick up your handset when asking your question. To withdraw your request, press star 2. One moment for the first question. Our first question is from Glenn Schorr with Evercore ISI. You may go ahead.
Hi, thanks very much. So, interesting comment about the driving towards 30 to 50% payout ratio eventually. I guess it brings up the strategic question of what's left to do, meaning you've scaled up, you've gotten a lot more global, you've broadened the board, you have China, ETFs, fixed income, solutions, everything that's working. So what else would you be using your cash flow in the future besides capital return? Is that for like broadening things like alternatives? I'm just trying to put that numbers question in a more big strategic question. Thanks.
Thanks, Glenn. Let me make a couple comments, and Allison can chime in too. So, look, we've had the conversation. The industry is just increasingly competitive, and reinvesting in the business is still a high priority for us. And as you say, whether it be product extensions for us to buy more in private markets, continue to focus on that business and grow there. So again, there's just a lot of demand that we would have internally, and we continue to make those investments to just increase our competitiveness and continue to evolve the business in line with client demands.
Yeah, I mean, I would just add, I think you could sum that up with just we seek to improve and increase our strategic optionality. We want to have the ability to continue to invest in the business. We want ample cash resources for any downturn or any sort of market volatility that could lie ahead. We want to be in position to continue to pay down our debt, and we have a $600 million note that comes due next year. We do have the remaining MLP liability, which I noted has in the fourth quarter, and we have ample cash resources to handle that. And so really, as we think about the balance sheet, and you've seen the progress we've made over the last 18 months or so, we really are trying to put our balance sheet in a very strong position so we have the strategic optionality. That will include returning capital to shareholders, but we want to be in a position to really balance our priorities, which does include improving the balance sheet, investing in the business, maintaining strategic optionality, and returning capital to shareholders.
Okay, thanks both for that. Thank you.
Thank you. The next may go ahead.
Good morning. Thanks for taking my questions. First one, to just start on waivers. Allison, you flagged 0.6 basis point competitive dynamics and whatnot, but how many hikes do you think we would need before those go away? Because as the forward curve tells us, we're getting closer to that. So I want to sharpen up the model there.
I do think just the single first hike will certainly be helpful to starting to reduce those money market fee waivers. It'll certainly help on the institutional client side for sure. It does depend on a lot of supply-demand dynamics, the overall availability of the securities to purchase. And so the change in Fed funds will be helpful. It won't be the only factor that will determine how quickly it goes away. And just an increase in short-term rates overall will help on the retail side as well.
Okay. Well, just I guess following up on that, was waivers in the past, was there a certain threshold for short-term rates? Something like 50 basis points would be sufficient. Is that fair?
I think that's right. I'd have to go back in the cobwebs and remember, but that sounds about you're in the right zone. And I'd come back to Allison's comment, though, too. It's going to depend on the competitive dynamics.
Of course.
Usually all freed it up.
It's probably not an unreasonable expectation. It's just how quickly when we get there can we unwind it.
Okay. Fair enough. Okay, thank you. And then there's been some speculation in the news about a potential tie-up with you all and another large financial services firm that has a big asset manager. Curious what you can say about that, and then separately, you guys have been very clear that M&A, when it's done right, is definitely a strategic consideration for you, and something that is important and can be value creative when done right. can you maybe walk us through your priorities on the M&A front and whether or not Invesco is interested in being a seller?
So I can assure you that we're not interested in being a seller. So let's start there. But let me back up and put in context. As we look at our capital priorities, and Allison and I just spoke a second ago about that, it's first reinvesting in the business to sort of increase our competitive positioning. But then strategically, what we look at is, we look at where client demand is, and if we can't fill the gap internally, we would look externally. So it has to make strategic sense. It has to be complementary to our business. It can't be duplicate to our business. That never works. Clients don't like it, employees don't like it, and by the way, shareholders don't either. And I've come back to the point time and time again that you have to have the wherewithal to ensure you're protecting what you bought while creating a better organization. And also, very importantly, as we look at it right now, the priority is, again, continuing to build up what we have. As I mentioned a few minutes ago, it is our private markets business where we're spending specific amount of time as we're seeing client demand, and in credit in particular, that's been an area in some extensions in our real estate area. So not much different than what we've talked about in the past.
Thanks for taking my questions.
Right.
Thank you. The next question is from Dan Fannon with Jefferies. You may go ahead.
Thanks. Good morning. Just wanted to follow up on the momentum in China. You guys have been highlighting this for several quarters. The numbers have been good. Curious about the retail distribution and kind of how, diverse and entrenched you are with the third parties, the banks and others in there, and maybe talk about if there's certain concentrations in either regions or partners, or just a little more color on the distribution breadth that you have there.
Yeah, I'll make a couple comments and then Allison will add. So as you looked in the materials that Allison referred to, it's 60% retail, 40% institutional. The retail comes through the joint venture. You end up with any number of distributors. Yes, there's the obvious banks and insurance company, but an area real strength and growth is really the e-commerce distribution channels, and there's many different avenues there, beyond Ant Financial where successful. So the concentration risk is not, an issue for us, and we just look at the whole distribution landscape to continue to open and broaden. But again, it is a very competitive landscape, so don't misunderstand my comments.
I don't know that I have a whole lot to add to that. I mean, I think, the online distribution channels have really overtaken the banking distribution channels in terms of market share overall in China, and just given the time we've had there and across those traditional banking distribution channels, which continue to be very good, but also in this emerging online trend, also very strong institutional relationships there, which are going to continue to be important drivers of long-term growth in China.
Got it. And then as a follow-up for fourth quarter, just there was basically an investment gap for some period several years ago where you didn't put money to work, and so the vintage is not like the timing is just off, and just curious how that doesn't tie to performance. Just making sure I understand the dynamics of this quarter and why the fourth quarter 21 and how we should think about that maybe for fourth quarter 22, assuming performance holds here and we would see that come back or normalize again next year.
Yeah. I wouldn't say there was an investment gap, and the nature of just performance fees and how they are structured into various contracts just remains, it's very bespoke, and it can be somewhat chunky and difficult to predict. There wasn't an investment gap, but as we do look at just the vintages of what has performance fees in it, that would be eligible, it is not the typical year-end spike of what we would typically see. So no performance misses, just the way these vintages are kind of cycling through and what we see in the fourth quarter of this year. We continue to have about $58 billion of AUM overall, have strike dates, if you will, or at least at the end of this year, that would incur or recognize performance fees in the fourth quarter. So our expectation is that fees in this quarter will be consistent with the experience we've had in the first 3 quarters of, in terms of what that means for 2022 or beyond. It's just simply a function of timing with the vintages this year.
Thank you. The next question is from Patrick Davitt with Autonomous.
Hey, good morning, everyone. You touched on this briefly in the prepared remarks, but China flows were obviously remarkably resilient given the increased volatility we saw there last quarter. Could you give a little bit more detail on kind of the flow and investing trends you saw through that volatility? Was there any kind of drop-off in activity as the volatility got worse later in the quarter? Just in short, what I'm trying to get to, do we need to worry about these flows slowing or even reversing if Chinese volatility continues to get meaningfully worse, or do you think 3Q suggests they could be resilient through that?
I'll make a couple comments. And so if you're going to take to the beginning of the year after Q1, we thought it was such an incredibly strong quarter that it couldn't be repeated, and slowed some but continued to be very, very strong. And just what we're seeing is there was just movement of investor behavior from really equity capabilities that were sort of growth focused to value focused, and just continuing to work through the broad range of capabilities. So it's hard to predict what's going to happen, but we're just not seeing that fall off to the degree that you would imagine in those very volatile periods, as you saw if you went back to 2015, something like that. So what's really important is in a positive way, and the regulators have been very focused on providing a greater investment and retirement savings market, and you're seeing that. So I'm not going to say that we'll never be in net redemptions, but it's been very resilient through this year, even with the volatility that we've seen.
Yeah, I mean, the only thing I might add, if I look back over the last 5 quarters, this was our second highest quarter for flows in China. I think the volatility, we didn't necessarily see it trend down inside of the quarter. And in some of that volatility, you started to just hear, I'll call it softening in sentiment really in the second quarter, and you see that more in the second quarter flow results. If I look at the flows into the joint venture in particular, it was about $7 billion, which of that product launches drove a couple $2 billion. The remainder was really through existing products, particularly fixed income. There was a lot of strength in our fixed income capabilities. That's different than what we saw in the first quarter, where it was new product launches that drove the majority of the flows. I think that not only speaks to just the strength and the sustainability in the market, but also the breadth of the capabilities in our platform.
Thank you. The next question is from Ken Worthington with J.P. Morgan. You may go ahead.
Hi, good morning. The next sales picture continues to be quite solid in the UK. It seems like outflows are persisting in the UK, but getting better. So a couple questions. So you mentioned GTR. I think you said $1.7 billion of outflows in the quarter. How much does GTR still manage, and is the expectation for continued outflows given the performance there? And then what products and businesses are working best in the UK, and what is the outlook for the UK to sort of move back broadly to positive flows in the future?
Why don't I start with GTR and a little bit of that, let Marty chime in. So in terms of where GTR is today, at the end of 9/30, it was down to $8.3 billion. That was down from its peak of $30 billion. The outflows in the quarter were $1.7 billion. Now, that $8.3 billion is not entirely in the UK, but it is largely in the UK. In fact, what is reflected in the UK is about $6 billion. So we are down to a point of at least diminishing headwinds. We do have an expectation that it will continue to decline. So I don't think we have seen a bottom there, and we do expect it will continue to decline. But the headwinds are diminishing. And I think you see that just in terms of the improved outflows for the UK this quarter with $1.8 billion in outflows, which is an improvement from $3.2 billion in the second quarter. So despite some of those outflows, we do see retail our UK equities. And so there are, I will call it, bright spots and green shoots as we continue.
Yeah, I just had a couple things. So I think also important, when you look at the period we've been through with UK equities in particular and underperformance, the sort of sentiment was quite negative in the sector too. The combination is not very positive for results. The short-term performance has improved quite dramatically, and in the UK equities, which is important. The ETF flows are the other area where we're seeing demand, and also the institutional business. And as we look forward, as Allison said, we're having some good expectations of being back into flows in the UK here.
Okay, great. Thank you.
Yep.
Thank you. The next question is from Robert Lee with KBW. You may go ahead.
Great. Good morning. Thanks for taking my questions. Maybe Marty and Allison, just like to go back to the business. So, I mean, you've talked for a while, the JV, and maybe bringing it up to majority ownership. But, I guess one question would be, does it really, since you operate it, I mean, does it really even matter, getting to majority ownership? Is that even something that, is at this point even possible? And then have a follow-up question after that.
Yeah. So, well, you hit it right on the head. I mean, the fundamental difference that we've had as opposed to every other joint venture that we know of, there could be someone similar to us. I don't know who that is, but having sort of management control has been the separating factor. And so I think most people use majority. We can use with our joint venture partner. It's likely we'll end up with a majority, but it's not going to be a huge change in the ownership, but it's not going to get in the way at all of our development. So you really hit the point that is most relevant for our success there.
The only change, if we were to do that, would be an accounting change in terms of how we recognize the joint venture on the P&L. It wouldn't change anything day to day in how we operate it or the success of the venture.
Okay, great. And then maybe the follow-up to shift gears quarters, but there was a time where you made some acquisitions, made investments in different technology platforms, and I know bringing them all under the IntelliFlow. Strategic positioning or importance of that, and maybe to what terms you're starting to see some positive impact in the flow picture, if at all.
So you're right. It was a combination of 5 smaller acquisitions to create the platform. Last year was a year of pulling it together under the IntelliFlow banner. The largest and most developed of is IntelliFlow in the UK, which still has a 40% market share. We continue to look at ways to not just advance the technology, but how can it advance flows in that market. We've had some great success with that right now, but we're continuing to challenge that. Here in the United States, the same thing, where we think the opportunity is serving the RIA market. And again, we're now just frankly turning our attention to it after really the consolidation last year. And so, look, we still think there's, if you just look at the way digital technologies are being used in a place like China, that's really what gave us the impetus to spend time and energy there. It has proven to be stunningly successful in China. There's different regulatory barriers here in the United States and structures and the like, but we still think there's an opportunity for success there. And we'll see in the quarters ahead if we're right.
Great. Thank you for taking my questions.
Thank you.
Thank you. The next question is from Bill Katz with Citigroup. You may go ahead.
Okay, thank you very much for taking the questions this morning. So first question is just on the opportunity to take advantage of the democratization of retail alternatives. Could you maybe expand a little bit on strategically what you're doing there to gin up the volume? Certainly the $1 billion or so is favorable and the $4 billion overall is very good, but we're seeing some very big numbers elsewhere and sort of wondering what you're doing to leverage both the product and distribution relationships you have.
Yeah, Bill, great question. So, it's where we see the immediate opportunity for us is with our direct real estate business. Earlier in the year, we entered into a partnership with UBS using ENRE real estate capability that's being distributed in Switzerland, Asia, and EMEA. We now have an ENRE product here in the United States, and we're just working with our distribution partners right now to get it on the platform. It's probably going through the end of the year to get to all the platforms that we're hopeful to get on. But we look at it as a huge opportunity just because there are very, very few competitors there. And if you look at the success and pedigree of our real estate team, it's very, very strong. But it's traditionally been in the institutional market. It has not been in the real estate market, and that's really, Bill, I think where you're going is a combination of having alternative capability, but also the ability to distribute into the wealth management platforms, and that's what we're looking forward to hopefully taking advantage of.
Great, thanks. And maybe one big picture question as well, just to follow up. Some of the distributors are talking about accelerating the direct indexation opportunity, sort of customized thought process. How would that affect Invesco, good or bad?
Well, it's hard to know. It all depends on where everybody goes. What we do have is, we have a self-indexing capabilities we've had in building models. We use that in those model creations. So you could see that continue to be an extension there. Also, with our institutional clients, again, we're using that self-indexing capability, to build customized, indexes for our institutional clients. So, we look at it as we're probably one of very few institutions that have that capability, and we expect that we'd use it probably in partnership with a number of our clients and wealth management partners.
Thank you.
Thanks, Bill.
Thank you. The next question is from Brian Bedell with Deutsche Bank. You may go ahead.
Great. Thanks. Good morning, folks. Maybe just back on indexing and on the M&A front, in terms of the strategic optionality that you mentioned, Allison, in the comments you mentioned, Marty, as well. Just, I guess, how important is having a beta index franchise? So, as opposed to smart beta and, a beta ETF, on your own. And then also, I guess, would you consider a joint venture as an option in doing that if you had, and I assume you'd want management control of that, just like you have in China.
Yeah. So, look, if you just follow the flows, I mean, there continues to be demand in cap-weighted indexes and also in smart beta. Our history is that we really started in sort of the smart beta category, and you're seeing just ever increasing demand there. So it's really the answer is both, is what's happening in portfolios, and you want to be relevant in those marketplaces. And our focus has been heads down and continues to grow. And Allison talked about the Qs in particular. Recognizing it's the limitation we have from a fee generation point of view, but it's been very, very important for building out our ETF platform and the reputation of the firm. So again, we'll be kind of positioning and determine which is the best way forward. But so far, I'd say our success has been quite good.
If you did want to enter into an arrangement, would you consider a JV in that type of structure, or is that not even doable?
It's hard to know. I mean, it's all facts and circumstances, so I wouldn't want to speculate on it.
Great. And then just on sustainable flows for 3Q and total dedicated sustainable AUM, and I don't know if you wanted to comment also on the Bitcoin ETF strategy between physical and futures for that option.
Yeah, why don't I start on what we're doing in Bitcoin and the like. So we've entered into a partnership with Galaxy Digital. That's who we're going to work with to build out our whole suite of ETF capabilities. Underlying blockchain technology, digital assets, and crypto. Our focus is on a physically backed current. It's going to be some time, I think, before we get into the market, right? It's at the SEC right now, and we've all known that they're still working through that as a topic. We've introduced 2 ETFs into the market that sort of invest in companies that build off and play on the blockchain technology and the like, and doing a futures backed product, because we think that the best alternative going forward is really the physically backed route.
And on your sustainability question, I think our flows into ESG capabilities in the third quarter was a little bit soft, about $300 million positive inflows in the quarter. We continue to have about $51.5 billion of AUMs that we would consider to be ESG funds and mandates, and that really spans across 160 ESG funds and mandates in a variety of asset classes. And importantly, we remain the second largest ESG ETF player in the world. Flows are a little bit softer in the third quarter relative to what we've seen in the first half of the year. Nothing to point to one way or the other there, but our expectation is to continue to see demand for those capabilities.
Great. Thanks for all the color.
Thank you. Our final question is from Alex Blostein with Goldman Sachs. You may go ahead.
Good morning. Thanks for taking the question in the prepared remarks. So definitely impressive to see the margin extension despite the headwinds that you've seen in the fee rate. But I'm curious how you're thinking about the margin trajectory longer term, assuming a more normalized market, which normalized is always a question mark, but clearly market tailwind has been pretty significant over the last year or so. So with the cost cutting percent level over time, assuming again kind of a more normalized market spectrum.
Yeah, I mean, I would say a couple of things. One, in terms of outlook for net revenue yield and just how we think about the fee rate from here. I mean, the biggest driver is always that's going to have a huge impact, and as we continue to see client demand for all of our capabilities, but certainly increasing demand for our passive capabilities, you see that downward pressure. At the same time, market impact can work in either direction, and it doesn't work consistently across those different asset classes and capabilities, and so it's inherently difficult to predict for that reason. In terms of, though, just bigger picture, how do we think about it? I mean, I do think we'll continue to see some modest downward pressure on it just as we continue to grow our passive capabilities, and we see demand for those capabilities. Hopefully it was also helpful to kind of understand the impact that the QQQ has on that. And so while it puts downward pressure on net revenue yield, it creates a tremendous benefit for us through the marketing support budget that it provides us. And I think, really most importantly, we are able to generate that positive operating leverage and really improve margins against this. And so where do I think it goes from here? I'd say a couple of things. One, as we kind of come towards the end of this expense management effort that we put in place last year, and we expect to complete that next year, I don't think we have to continue to do things like that in order to sustain these strong operating margins. We've got an expense base that's over $3 billion. It's a significant budget to work with. And so how we think about it is really how do we deploy that expense base? How do we continue to reallocate where we invest against our areas of highest demand? And as we've built out the breadth of capabilities, that scale and the volume of flows is what continues to generate, really the positive operating leverage that we're looking for, and gives us the opportunity to sustain these, 40% plus operating margins, even with some of that downward pressure in that net revenue yield. And I appreciate you asking the question because I think it's a really important point that we wanted to drive home, and we wanted it to come through today. Because this didn't happen by accident. It really reflects a lot of deliberate work by the company over the last couple of years and an operating expense base that really gives us the leverage we need to continue to invest in the areas of growth that we see ahead.
Perfect. Great. Thank you very much.
Thanks, Alex.
On behalf of Allison and myself, thank you very much for joining. I appreciate the questions and engagement, and I look forward to talking with everybody next quarter.
Thank you. That does conclude today's conference. Thank you all for participating. You may disconnect at this time.